Investment Solutions here at AJ Bell. Before we head into the presentation, I'm going to ask you a quick question, if I may. And I think it's something that we've got a problem with in this country. And so I'll go ahead and ask you the question, right? So who in this room has perhaps been too cautious at some point in their lives and had too much of their savings in cash? Right. So we do have a problem, don't we? So there's a couple of statistics around this. Last statistics I'll use in this presentation, first and last. So there's 13 million people, it's estimated, in this country that have excess cash savings. So that's cash savings in excess of what they need in an emergency situation. And it's estimated that that's 430 billion pounds. 430 billion just sat there in bank accounts. Cash ISAs, we love them, don't we? Cash ISAs, God. So there's people in this room that have done that. We need to get a message out there because cash is probably, and it has been historically, a terrible investment for the long term. So we need to start asking that question of people. Do you have too much in your cash savings? Because over the long term, inflation is going to erode that. Now, there's an old saying that kind of accompanies that, and I'm not a great fan of it, but this is not investment advice, but cash in the long term is trash, okay? So we need to think about that as a nation, really, and get people involved in investing. So, jumping into the presentation, hopefully you all know what AJ Bell are roughly all about. Our purpose is to feel good investing. That's what we want to make you feel. And how do we do that? I like to think about that in terms of peace of mind. So we're one of the largest platforms in the UK. We have over 80 billion pounds of customers' money that's handled for in our accounts. And we have over 500,000 customers. I have over 1,000 colleagues. Most of them sit just across the road in one of those buildings there. And when you need us, you can call us, and we pick up the phone quickly as well. And I've already heard that tonight, and I think I've seen a few nods already. We pick up the phone, and when we pick up the phone, we talk to you in a knowledgeable and straightforward manner. We don't use the jargon. We don't need the jargon, do we? We've got a terrible problem in our industry with jargon. So we break down those barriers to invest in. Okay? So I'm specifically from AJ Bell Investments. That's what the business unit that I work within. And that's the asset management arm of AJ Bell. We manage portfolios for over 60 billion pounds of customers' assets. So that includes direct customers and customers of financial advisors as well. Over 3.5 billion of that is within the 9 funds that I'm going to talk about to you today. And you don't have to take my word for it in terms of what our investment proposition is about. It's award-winning. I've just put a couple of awards on the screen here. Some of the most recent ones, particularly proud of the one that includes my job title, but includes ones that not only about the solution, but the performance and what we're actually delivering in terms of end value to customers. And we're particularly proud of that. So what do we want to give you? What's our mission? Well, it's to make you look like this guy. Relax. Put your feet up. Feel good when you're investing. That's what we all want to do. That's why I'm here. That's my purpose. And how do we do that? In 3 simple buzzwords. Simple, low cost, transparent. I'm tall, so I'll jump down maybe. Simple. When you buy one of our funds, you get an instant portfolio. It's diversified. You can buy 1, you can buy 2, 3. But when you buy one of them, you get an instant portfolio in terms of diversification. You've got underlying exposure to thousands of companies in terms of their stocks and in terms of their bonds. So you've got exposure to some of the largest companies across the world, but you've also got exposure to ones in Japan, China, emerging markets, Asia as well. And in terms of the bonds and on the equity side, if something goes wrong with one of those companies, you're diversified enough to make sure that it doesn't make a large impact on your investment return over the long term. Now, we've had a Glaswegian, haven't we? I'm a Yorkshireman, I'm tight. We focus on low cost. We invest in low-cost passive products to make sure that the majority of your money is put to work so it can benefit from the compounding effect of markets over the long term, okay? But we're not passive in terms of our allocation to passive funds. We're active. We're constantly looking for efficiencies because there's big gains to be made or relative returns that are lost by investing in relatively expensive and inefficient tracker funds. And there's constant innovation in our industry. There's a lot of price competition. So when we see that price competition coming through and we see an efficiency for the portfolio, we take advantage of it. It's about keeping that money invested and compounding over the long term. And finally, transparency. This isn't my money, it's your money. You should know where it's invested. We give you a full breakdown of your portfolios anytime by just looking through basically an X-ray of the funds at any point in time. And we regularly communicate with you through a variety of mediums, mainly through the website. We do videos every quarter. You can get a quick update on what's going on in the funds, what's making the difference. And when we make a change, we'll communicate that with you as well. And on the website, the access to information is easy as well. Sounds great, doesn't it? So now you're thinking, well, what's the name of the fund then? Well, we've got a commitment to choice. We've got 9 funds for you to choose from. We've got 6 growth funds that focus on capital growth. They target different levels of risk, so different levels of equities and bonds within them. They invest in passive products, as I've mentioned. We've got 2 income funds. They focus on targeting a long-term yield of between 3% and 5%, okay? And that's regular income. We pay that monthly. So you can factor that into your cash flow plan, into your financial plans, whether or not you do or don't have a financial advisor. And then finally, we've got a responsible growth fund. That's, as the name suggests, investing responsibly. It's targeted on long-term growth, and it does that by exposing itself to companies that are best in class with regards to ESG risks, so environmental, social, governance, sorry, I used some jargon there, environmental, social, governance risks. So what's our focus in terms of where we're managing the funds? Well, it's asset allocation. It's what we can control. It's your equity bond split. That will determine the level of returns that you receive over the long term, or it should do in the majority of cases, okay, if you're diversified. And we focus on risk as well when we're doing that. And when we're doing that, we're thinking about the long term all the time. We're not interested in the short-term noise, what's going to happen what happened last week, the week before in markets, what's going to happen next week. We try and cancel out the noise. I used to work at a business that used to have Bloomberg TV, some of the financial news on every day. That was me. I was sat there, just fingers in ears all the time. It was terrible for investment decision making. You have to zoom out, think at the top level. Digging into that a little bit deeper, we use diversification. It's a big friend of investors over the long term. As I mentioned earlier, if anything goes wrong, that's our safety net. The way that we look at that principally is that equity bond split, and then we break it down by currency. Not that we're managing currency, it's because that most of our investors are UK investors. They'll have liabilities, debts, mortgages, retirement costs that are going to be based in sterling. So having an appreciation of how much currency risk is one of our key focuses. We don't manage that currency risk actively, we just know where it is at any given time. And then we further segment that. So in the equity space, we think about markets in the UK, the US, Japan, Asia, emerging markets. Again, diversified. On the fixed income, on the bond side, sorry, jargon. We think about how much interest rate risk we want to take. What type of companies we want to lend to. Are they high risk, are they low risk? Are they governments? How long do we want to actually lend to them for? So, quote there that gives it some academic weight, but it's really about the diversification of the portfolio that you can see. Then the next step is risk. So as I mentioned, we've got 9 funds. They take incrementally more risk. Income fund sits somewhere near the balance fund. Income and growth sits near the responsible one, the adventurous fund. And what we're trying to do is be valuation sensitive. So we take valuations into account when we're building these funds, and therefore we're thinking about the efficiency. So for every unit of risk that we take in the portfolios, we're maximizing our potential long-term returns. We're big believers in the fact that your long-term investment return is dictated by the price that you pay. There's a quote in there somewhere from Charlie Munger, but I can't remember it exactly. But you get what I mean. So, again, you don't have to rely on me talking about this. It's all about the track record as well. We've got a 5-year track record. This is the 6 growth funds. These are what are considered to be our peer group. You can see here, risk on the bottom, return on the y-axis. We are consistently improving the efficiency of investments, okay? And it's not by much. It's just by 1%. It's by 0.5% here and there. But over the long term, compounding that up makes a big, big difference to your investment return. So, in summary, simple, low-cost, transparent, buzzwords, but it's what we like to stick to in terms of investing your money. We've got a broad spectrum of choice in terms of funds, and our focusing on asset allocation and risk. You notice I've not mentioned stock picking at all. That's not what we do. It's not our job. We leave that to other people. And what's the end result? It's diverse portfolios. Thank you very much.